Financial markets were built to answer one hard question: who gets command over the future? Every market price is a claim about tomorrow. A stock price estimates future profits. A bond price measures trust in repayment. A futures contract fixes a price for goods or money before the future arrives. Behind the screen sits a simple machine. It moves savings from people who have capital now to people who promise to use it well. It also decides who bears the damage if that promise fails. Markets turn uncertainty into quantities. Before modern finance, wealth moved slowly. Land was fixed. Harvests came once a year. A lord controlled territory, labor, and storage. Power stayed close to production because wealth had weight. You could seize a field. You could count cattle. You could demand grain. Finance changed the shape of wealth. A merchant could own part of a voyage without boarding the ship. A banker could hold a claim on taxes not yet collected. An investor could sell a piece of a company to someone he had never met. Once wealth became a transferable claim, power no longer had to stay where production happened. The early stock market made that change visible. In 1602, the Dutch East India Company sold shares to the public. The company needed huge sums for ships, crews, weapons, warehouses, and long voyages. A single expedition could return with a fortune or disappear at sea. No ordinary trader could carry that exposure alone. Equity shares solved the problem. Many investors could fund the same enterprise. Each investor owned part of the upside and shared in the potential loss. The stock market added something more powerful. It let those claims move. An investor did not have to wait for every ship to return. He could sell his share to another buyer. Risk became portable. That was the breakthrough. Capital could gather at scale. Trade could expand beyond the wealth of one family or one port. But the same invention created distance. An investor could profit from a voyage without seeing the sailors, the violence, the monopoly, or the empire behind the dividend. The joint stock company solved the problem of scale. It created the problem of distance without responsibility. Government debt pushed the same mechanism into politics. In 1694, the Bank of England began as a private bank that acted as banker to the government. Its first great function was war finance. The state needed money before future taxes arrived. Investors supplied that money. In return, they received interest backed by public revenue. Debt moved future taxes into the present. A government with deep credit can fight longer, build faster, and survive shocks that would break a cash-only state. The lender gains income. The state gains reach. The taxpayer carries the obligation. Financial markets made states more capable. They turned public authority into payments that investors could buy, sell, and trust. The bond market became a court where governments were judged every day, not by law, by price. That is why financial markets matter far beyond Wall Street. A falling bond price raises the cost of debt. A falling stock price can threaten management. A frozen credit market can stop payrolls, construction, and trade. Prices are not just numbers, they are economic commands. Economists call this price discovery. The phrase sounds dry, but the mechanism is ruthless. Buyers and sellers bring information, fear, greed, memory, and doubt. They negotiate by putting up money. Out of that contest comes a live estimate backed by risk. When the estimate works, capital flows toward projects that can compound value. When it fails, capital floods into illusions. Financial markets sit between invention and reality. A brilliant idea still needs funding. A factory needs equipment before it can sell goods. A government needs roads before it can collect the growth they may produce. Finance bridges that gap. It provides present resources for future plans. But the bridge charges a toll. Investors demand returns, control, collateral, or protection. The market asks who gains, who absorbs the loss, who exits first, and who cannot exit at all. Liquidity answers the exit question. A liquid market lets investors buy or sell quickly without crushing the price. That ability makes people more willing to invest. They can enter because they believe they can leave. Liquidity turns a long-term asset into something that can be treated as short-term. It makes capital bolder. But liquidity can vanish. The door that looked wide can narrow during a panic. When everyone wants to sell the same thing, the price falls through the floor. The same feature that attracts capital in calm times can spread fear in a crisis. Commodity markets show the mechanism in a simpler form. In 1848, the Chicago Board of Trade began as a cash market for grain. Forward contracts appeared almost immediately. A farmer faced brutal uncertainty. The crop was planted months before the sale. Weather, transportation, and demand could wreck the price. A forward contract let a seller and buyer agree on terms before delivery. This was not speculation in the shallow sense. It was planning under risk. The farmer could lock in revenue, the miller could lock in supply, a trader willing to bear the price swings could take the other side. The market relocated uncertainty. That is finance at its best. It puts risk in the hands of someone willing and able to carry it. Modern derivatives use the same logic. A derivative gets its value from something else: a crop, a currency, an interest rate, or a share price. In careful hands, derivatives act like insurance. They let airlines hedge fuel costs. They let banks manage interest rate exposure. They let producers plan with less fear. But every tool that moves risk can also hide it. A contract can protect one party by concentrating dangers somewhere else. A hedge for one balance sheet can become leverage for another. The system looks safer because the danger has left the original owner. It may only have moved into a darker room. The 2008 crisis exposed that mistake. In the early and mid 2000s, high-risk mortgages were pooled, repackaged, rated, and sold to investors. The theory was familiar: slice the exposure into pieces and send each piece to buyers seeking different returns. The market appeared to transform weak loans into safe securities. It did not erase the risk. It renamed it. When U.S. housing prices fell and borrowers defaulted, investors could not tell what many mortgage-linked claims were worth. Price discovery broke down. Trust in ratings collapsed. Credit tightened. Institutions that depended on short-term funding discovered that money could flee faster than assets could be sold. The crisis happened because the system lost track of who carried the exposure, how large it was, and who would pay when it surfaced. Financial markets work only when claims stay connected to reality. A share must connect to profits. A bond must connect to repayment. A derivative must connect to an exposure someone understands. When claims multiply faster than understanding, the market stops allocating capital and starts allocating confusion. Confusion still has winners. Fees are earned when financial products are created. Bonuses are paid before losses mature. Gains can be private while bailouts become public. This is the political edge of finance. Markets allocate not only money, but also power, blame, and liability. Regulation follows every major financial disaster. Rules try to enforce disclosure, capital buffers, clearing, and accountability. They cannot abolish failure. They can make risk harder to hide. They can force the question markets prefer to avoid: who pays if this breaks? The answer matters because ordinary people are inside the system, even if they never trade a stock. Their pensions hold equities. Their mortgages depend on credit markets. Their jobs depend on business investment. Their governments borrow in bond markets. Their savings move through banks, funds, and insurers. Financial markets are not a casino outside the economy. They are a control center inside it. Finance can fund productive work. It can pay for housing, energy, medicine, transportation, and technology. It can spread the cost of long-term projects across millions of savers. It can give entrepreneurs a path from idea to scale. It can also reward extraction. It can pressure firms to cut workers to raise margins. It can turn homes into yield products. It can treat forests, water, illness, and debt as tradable cash flows. The market does not ask whether an outcome is decent. It asks whether the claim will pay. So the ultimate purpose of financial markets is not justice. It is not wisdom. It is not growth by itself. Their purpose is to price the future, move capital based on those prices, and assign the cost of being wrong. That function is necessary. Without it, savings sit idle, projects starve, and risk remains trapped with the people least able to bear it. But it is dangerous for the same reason. It gives immense influence to whoever can shape prices, write contracts, control information, and exit before others can. The real question is whether the market serves the economy or forces the economy to serve the market. A healthy financial system connects capital to useful work and keeps risk visible. A corrupted one turns claims into weapons and sends losses to those with the least power. The screen shows prices. The deeper story is command and power. Financial markets exist because the future is uncertain, capital is scarce, and every promise needs a price. Their highest purpose is to make those promises useful. Their greatest danger is making them look safer than they are.